Megan, it's great to have you. A couple things. You say, look, a recession is quite possible, but the playbook, at least post-war period, has proven that markets tend to bottom even as the economy continues to deteriorate.
Yeah, thanks for having me, Carl. So we've raised our recession risks. Still not part of our base case, actually, simply because we are starting from such a strong level to begin the year. But the risk of the Fed tightening more aggressively is clearly front and center. But if you look at historical recessions, we've had recessions where the drawdown is at or even less than what we've seen so far. And if you are taking a financial crisis or a COVID-style economic shutdown off the table, then I think something in the 20 to 25% drawdown range for the S&P 500 starts to get attractive. And the playbook there is a bit counterintuitive, but those higher beta names, small cap, technology, tend to lead us out of the recession. So I think it's time to start getting that list ready and maybe not jumping right in just yet. I think this could take a little while to play out. We have a few more chapters to go, but it's definitely an opportune time to start looking and start maybe legging in over the coming weeks.
Right. When you think about tech being one of the first sectors to bounce, are we talking consumer tech or enterprise tech, or does it need to be that specific?
I would think enterprise tech. So what we've seen is a really strong period for consumer-facing tech, and that was really related to the COVID and post-COVID period, extraordinary stimulus, really healthy balance sheets and excess savings. I think going forward, I'd be focused more on consumer tech. We know that the move to the cloud is still early innings. So that is one area where we think even if we get a pause in CapEx spending related to technology, I think that is going to resume as soon as companies start to feel a little bit more comfortable. Again, that might take some time, but that is an area where we feel like we're talking about rather than demand destruction, a term that we use quite a bit these days, probably a delay in demand for for enterprise technology, whereas the consumer is probably going to be hunkering down a little bit more, focusing on staples, focusing on energy and food, because those areas of the spending complex are still seeing extraordinary inflation.
Megan, trying to read between the lines here, I mean, you don't sound that neutral. You sound kind of positive on the right tech names. And, I just don't want investors who are longer term, not who are trying to trade this week and make money necessarily, but who are longer term to miss it. I mean, it seems like you're saying you expect some of these names in semiconductors, perhaps like a Qualcomm, a Marvell, that were a lot higher a bit ago and were reporting upside earnings surprises when they were higher, that maybe they're worth considering.
Well, I think we're neutral. I think we're definitely neutral. But the way I would put it is that it's not the time to sell. It's the time to start thinking about buying and what you would want to be buying. So, the time to sell was a while ago. And I think for our clients who are long-term investors, it's not going to do you much good to try to get out of the market in big form now, maybe rotating out of some of those names that are not quite as attractive. But remember, when we're thinking about tech, there's been a rolling wave of bear markets, if you will. Started with kind of concerns about oversupply and shortages in the semiconductors, and then the reopening trade, which favored cyclicals and value over those stay-at-home tech names. And then valuations got killed when we saw rates move up earlier this year, and now we're in recession fears. So we've already seen a lot of pessimism in the tech sector specifically. And if you look at valuations compared to history, the Russell 1000 growth, which I know is not all tech, but has a lot of that influence, is trading about the 65th percentile versus history. And I think technology is just such an integral part of businesses and the way we live our lives that seems like a pretty good valuation starting point. I wouldn't be wedded to valuations in this market because we know that there could be some downside revisions to earnings estimates from analysts, and we do expect that. But I would say the time to sell has passed, and now it's time to be patient and think about how you want to be adding in the future.